Welcome to this explainer. Look, if you've spent any time at all trying to decode the financial markets lately, you've probably noticed a really fascinating and honestly kind of cruel contradiction happening right now. We live in an era of absolute information parity, right? As a modern retail trader, you've got access to the exact same economic data, the same consumer price index reports, the exact same central bank minutes as the big guys on Wall Street. You can literally pull up the global flow of money on your smartphone while you're just waiting in line for coffee. But here's the kicker. Despite this unprecedented access to high-level economic knowledge, everyday traders are consistently getting completely wiped out. Portfolios are just facing absolute destruction. So why is that? Well, today we're going to explore the deep mechanics of money, economics, and the markets. And we're not doing it through the boring lens of academic theory, but through the brutal, unforgiving reality of actual market execution. Just think about it for a second. If having perfect macroeconomic data was the secret key to wealth, every single economics professor would be a billionaire. But they aren't. And unpacking exactly why they aren't is going to completely change how you view your own portfolio. Let's get into it.
And that brings us to this idea. It really hits you the moment you realize that failure in the markets, well, it isn't about not knowing enough. It's entirely about poor timing. Most traders don't lose money because they lack knowledge. Now, that's a profound realization. It forces us to separate two completely different systems, the macroeconomy and the micro market. See, you could have a flawless understanding of inflation rates. You could perfectly predict the next central bank interest rate hike. You could completely grasp exactly where we are in the 10-year macroeconomic cycle, and you could still lose every penny to your name. Why? Because the localized market system doesn't pay you for understanding the global economy. The market is just this highly concentrated, hyper-localized system of buyers and sellers interacting at a specific millisecond in time. It literally does not care about a 10-year economic cycle on a random Tuesday morning. It only pays you for knowing precisely when to enter and when to exit a position at the exact right millisecond, regardless of what the broader economy is doing.
Section 1. The Illusion of Knowledge. Let's talk about how this endless sea of financial information creates a totally false sense of mastery.
Because honestly, we are just constantly bombarded by content promising true economic enlightenment. You can so easily find a 26-minute masterclass promising that, once you learn economics, you can never be manipulated. Or maybe you dive into a 34-minute millionaire roadmap, or a 22-minute guide on hitting a 10 lakh turning point to start building real wealth. And the psychology behind consuming this stuff, it's actually deeply deceptive. When we watch these breakdowns of the global money system, we get this massive dopamine hit of productivity. We basically trick ourselves into thinking that by understanding global trade deficits or fiat currency, we're actually doing the hard work of trading. But guys, this is the ultimate content trap. It's exactly like studying the advanced physics of fluid dynamics for hours and then somehow thinking that makes you a professional surfer. One is theoretical knowledge, right? The other is active survival. Consuming macro-level content makes us feel productive. It makes us believe we are actively trading, when in reality, we're just passively watching the ocean from the safety of the beach. And that right there brings us to a fatal disconnect known as the execution gap. Having all of this macro-level theoretical information absolutely does not translate into the mechanical execution required to actually place successful trades. Think about it. Knowing exactly how a complex multi-cylinder combustion engine works does not give you the split-second reflexes you need to steer a Formula One car through a hairpin turn at 200 miles per hour. The market is completely ruthless, and it severely penalizes hesitation. You can watch that 34-minute millionaire roadmap, feel incredibly inspired, open up your brokerage app, and then just stare completely blankly at a flashing green and red screen, totally paralyzed. Because knowing that the renewable energy sector is poised for massive macroeconomic growth over the next decade, that doesn't tell you if you should buy a specific energy stock at 9:35 a.m. today. It doesn't tell you the price action, the liquidity, or exactly where you should place your stop loss if the trade suddenly goes against you in the next 10 seconds. That is the execution gap, and honestly, it is the silent killer of retail accounts.
Moving on to Section 2, the execution problem. Let's look at why traders struggle so much to cross this gap between theory and execution. To cross this gap, traders have historically relied on this grueling process that takes an immense emotional toll. Just picture the reality of the traditional method for a second. You sit down in the early hours of the morning, you pull up these wildly complex candlestick charts, draw countless trend lines, and literally squint at the screen until your eyes strain. You're analyzing patterns for hours on end, desperately trying to force a narrative onto random market noise. It's just exhausting. And because this method relies entirely on manual, on-the-fly interpretation, human emotion inevitably takes over. You start second-guessing your own analysis, basically hallucinating chart patterns that simply aren't there, all out of pure desperation for a setup. Now, compare that psychological torture with the deep relief of modern clarity. Instead of reinventing the wheel every single morning in a state of high anxiety, a modern approach leans heavily on selecting a proven strategy from an established creator or system. It entirely removes the emotional guesswork. You aren't guessing anymore, you're just executing.
So, how do we get there? Section 3, AI and Market Strategy. We're going to see how AI tools are finally fixing these execution problems with mechanical precision.
The market has finally recognized this exact struggle, and specialized tools are stepping in to fix this with true mechanical precision. Tools like Bolt, which was launched by the CB-registered broker Lemon, break the whole process down into 3 actionable steps that totally strip away the emotional baggage. Step 1 is simply picking a proven creator strategy. You're leveraging an existing, back-tested system rather than just improvising on the spot. Step 2, and actually this is arguably the most difficult part of trading, is waiting for the setup to be ready. Retail traders notoriously overtrade because, well, they get bored staring at screens. They take bad setups just to feel the thrill of the market. But a mechanical system completely enforces discipline, keeping you safely on the sidelines when market conditions are poor. And finally, step 3 brings the psychological payoff. When the setup finally triggers, you get the complete trade delivered directly without hesitation. No panic, no second guessing, just pure, clean execution.
Let's dive a little deeper into why these specific pre-trade metrics fundamentally change how you interact with market systems. Instead of floating in this cloud of economic theories, you get hard, real-time data before you risk a single rupee. You get a precise entry level, which completely eliminates that fear of buying too high. You get a firm target price to lock in profits before greed takes over. And most importantly, you get a clear stop loss. Now, in the micro market system, institutional algorithms are constantly hunting for liquidity, right? They sweep the board to clear out retail traders who are just guessing. So having a mathematically defined rigid stop loss protects you from those brutal institutional sweeps. Furthermore, you get to see the strategy's historical win rate, its past performance data, and its exact returns for that specific day. This brings all those massive macro concepts down to mathematically defined execution levels. It literally replaces human anxiety with algorithmic clarity. So we started this explainer by unraveling the illusion of macroeconomic knowledge, proving that understanding inflation won't save you from a bad trade. We identified that crushing execution gap that destroys retail portfolios, and we explored how a shift toward mechanical, data-driven systems provides the ultimate solution. So as we wrap up, I really want to leave you with one provocative thought to rethink your entire approach to the markets. Are you relying purely on consuming endless economic theory, or are you actively mastering the mechanics of execution? Remember, the micro market structure does not care how many 30-minute macroeconomic videos you've watched. It only rewards precision, discipline, and exactly when you hit the buy and sell buttons. The shift from emotional guesswork to mechanical clarity, that is the true turning point for any trader. Thank you so much for joining me for this explainer. Now go out there, stop just absorbing theory, and take total control of your execution.